Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today, we're going to take a quick peek at the markets and then also look at last week's trade. We looked at oil last week via the USO, and then we're going to be chasing bears using butterflies. So we're going to do a fairly advanced trade once again. Last week we actually did a trade that I don't think I've ever done on the stock play of the day. It's one of the more aggressive trades, very speculative in the short term. The only way that we could have got more aggressive on the USO was to actually just buy flat out of the money calls, which would have worked out just fine actually. But I like to take this approach if I want to get bullish short term, and I wouldn't mind owning the underlying stock. Now, there's no name for the strategy inside the options playbook. Well, it's just straightforward in that we sold a cash secured put saying that if oil did come down towards that $80 a barrel range, we'd be willing to buy 100 shares of the USO, which is focused on oil futures. And if it did not, we're going to sell that put, use the premium as a kind of fear of missing out trade where we bought an out of the money long call spread and looked for a short-term pop. Now, there's been some news around it. The stock did move. So the trade worked out well on paper. And as always, everything is meant to be a paper trade here on the stock play of the day. We're just trying to learn. So I'm going to start by just looking at my VIX watch list, and we'll get in a little bit more detail about the market and what's going on there. But right now, we see the S&P 500 index just down a fraction. More importantly, this week, the VIX did have a run up, and I've been saying when the VIX was down below 20 that it just didn't make sense for it to be there. One of the biggest things about the VIX, and I guess I'll throw this chart over here on the right-hand side. One of the biggest things about the VIX is that we have September and October coming in. Now, this was right down around the 20 level. That's the support line that I had drawn. We did make a move up, even though the markets are a little bit down today. We see the VIX is up just a little bit. I think it makes more sense that the VIX would be around the 24 handle. As a matter of fact, I went back just because I've kind of been confused about the VIX. I went back and looked at a volatility chart that compared 30-day historical volatility to a VIX index, which is a 30-day weighted average. And since May, the historical volatility has been higher than what the VIX has implied all the way up until now. There's only a few days where the implied volatility actually bumped above the historical. And that's very rare because that basically says that we haven't had a big downturn. We've been talking about that moment for quite a while, where we haven't had that capitulation moment where you see the VIX skyrocket above the 35 level. We kind of see a couple of times where we come close to it, but we've never had it go up above the 40, even push the 50 level. And to me, that would be a sign of some capitulation in the marketplace. We kind of shake all the sellers out. So we have September and October coming, and I'm a little nervous about what could happen in the market, considering we're having such a big rally going into that. Now, obviously, we had a down day yesterday in the markets, but 4 solid weeks of returns in the S&P 500 index. And so we went back and we focused on oil this week. We're going to look at trying to be a little bearish in the S&P 500 index. It's going to be a speculative trade, just like we did last week. So I want to emphasize this is not meant to be a recommendation. It's going to be a fairly advanced trade. Once again, for a while we were just looking at bottom fishing trades where we were selling puts to maybe buy a stock at a lower price, selling put spreads on underlyings we wouldn't mind owning. And now we're kind of just jumped off the cliff and went really advanced here on the stock play of the day. And that's what I'm going to continue with this week, because I find it interesting. First of all, the VIX has gone up, and that did affect the strategy today because butterflies become cheap in higher volatile environments. So we're just going to look at the SPX, and we're going to have a very short-term move in the S&P 500 index and just look for basically a downturn going into the end of the week. That's simple. All right, so let's see what happened last week. All right, here's USO. This is just a 5-day chart. It's a 15-minute chart. And so if we go back 5 days, we see that the stock has made a fairly strong move from down when we looked at it on the stock play of the day. The stock was right around 71.76, 71 3/4, right down here on this end of the chart. So here's a whole day's worth of trading, another whole day's worth of trading, another whole day's, and here's where we're at today. So the market jumped on the news that Saudi might reduce production. That's just pure speculation, but from a couple of comments from OPEC, what might happen with OPEC Plus and Saudi Arabia, a prince saying that they may have to they may try to manage the market a little bit by cutting production. All right, so oil did jump, and it jumped up to basically where we were targeting, right above the 76 level. It got as high as, let's see where we're at here. It looks like around 77 3/4. Right now, oil is at 94 a barrel. When we were looking at it last week, oil was trading just south of 90. And our target where we wouldn't mind buying it was down around 80. More of a short-term speculative move, not necessarily looking for oil to be long 5 years from now. More so what's going to happen over the next 4 or 5 months. We have a lot of geopolitical concerns that is affecting the price of oil. Okay, so what trade did we do? With oil, we went out short term. The only thing that I guess you could say might have done wrong is that it would be better if we had a little bit shorter expiration. We sold the September 2nd expiration. That means we still have 10 days remaining. When we did the trade, it would have been around 17 days. Obviously, a week from today is when we were looking at the trade. And stock was around 71, 76. I should say ETF, right? The USO is an ETF that is based off of oil futures, the price of oil. And when we looked at the trade, we sold the 70 strike put, and we brought in, it was trading for a little bit more than $1, but we haven't had a ton of time decay. One of the biggest things is that IV is very high in the USO. It's higher than normal, and rightfully so with all the geopolitical concerns and everything that's in the news. So this was trading approximately around the same percent implied volatility. So you've been getting a lot of premium. But that also means that we got to get closer to expiration for this put to actually decay. Now, we didn't mind buying the stock if it came down to 70. That means that we would have done it cash secured. We would have had, if we sold one put, if we did this a 1 by 1 by 1, because it's 3 legs, we would be saying that we'd be willing to spend $7,000 to buy the USO around the 70 strike. We then went out and used that, actually it was selling for more than that because we brought in a decent credit to the account. but we went out and said we're going to sell this and use the proceeds to buy, basically speculate, using an out-of-the-money long call spread. And we were able to do this entire trade for a net credit to the account. So we bought the 73 strike call, so we went on the opposite side. The short put was, neutral to bearish. Now we're being very bullish on this trade, and that on the short put, we were saying we're willing to buy the stock if it came down, but if it just stays where it's at, that would be okay with us because we're going to bring in a net credit to the account. Ideally, our best case scenario was that the stock that oil made a dead cat bounce after coming down from 120 all the way down to $90 a barrel, and that we got that bounce and we got to move up on the upside. Okay. So that did happen. So we bought the 73 strike call, and then we sold the 76 strike call against it. Now, if we look at this, right now this would be done for a net debit if we did the whole trade in this situation of $1.44. We were able to do the trade last week on paper. We were able to do it for around $1.21 net credit to the account. So if we were going to unwind this position, so this would be the key here. We've reached our top strike. I think the move would be to unwind it. We would be able to sell this for a net credit of $1.44 to the account. Add that to the net credit we brought in last week. So interesting enough, we put the trade on for a net credit, and we can take it off for a net credit right now. And you would have the 144 plus the 121. And we would take the trade off and move on. Decide if you want to stick and do something different in the USO. But it was a very short-term speculative trade. We got to move to the upside, take the profit and move, right? Probably when it hit 77, I would have really considered it. Time decay is a big issue with implied volatility at 50% on these option contracts. And if you did stay another week, you're just hoping that the stock stays where it's at and you get some more time decay, because if the market moves up, it's obviously going to help the position. But the biggest thing now that you're battling is the premium in the short put that is still there and also in the short call. So time decay would help this position become more profitable now because we got the movement in the stock. But while you're waiting for those options to decay, what can happen is the stock can turn around and start going down. So how would I get out of the trade? If I'm looking at it, here's how we would do it. We sold to open this put. We bought to open that call. Sold to open the 76 call. Change them all up, right? So instead of selling to open, we're going to be buying to close. Instead of buying to open, we're going to be selling to close. And instead of selling to open, we're going to be buying to close. Now, you'd set all that entire trade up, and right now it shows you'd be doing this. We would try to do it somewhere at the midpoint, net credit of 145. Never on multi-leg trades do I ever enter market orders. I guess never say number. 99% of the time I'm going to put in a limit order and try to work it a little bit. If we filled close to the midpoint, that would mean we'd be doing this, closing this entire trade for a net credit of $1.45 to add to the $1.21 net credit we brought in last week. Simple enough. If you have any questions about it, you can throw them in the chat box. I'll address them at the end of the show. But we have a lot to cover today. And now that we don't do the stock play of the day overtime on Friday, we got to move fairly quickly. But if you have questions on this trade, throw them in the chat box. I'll be happy to answer them after we go through today's stock play of the week. And so the title on the title is Chasing Bears with Butterflies. Okay, so when I want to be bearish, short-term bearish, based off of what I'm seeing in the market, I like to use butterflies because butterflies are a way to manage risk, and you don't risk a ton. And being speculative in an index like the S&P 500 index, you have very expensive option contracts, mainly because the index is a $4,133 index. The more expensive the index, the more expensive the options are. And if you think of options, what they came what they originated as is as products to protect an asset. That's where the options market was derived from. The more expensive that asset, the more expensive the options are going to be. You think of car insurance. If you're driving a Bentley, it's going to be more expensive to insure that Bentley than it is your Chevy Cavalier, right? There's a little difference in price, and because of that, there's going to be a difference in cost in insuring. If we're trading options in the S&P 500 index, it's going to be more expensive than trading options in Walmart. That simple, mainly because of cost. Okay. So, chasing bears with butterflies. So let's look at what a long put butterfly spread looks like inside my book, The Options Playbook. And inside the book, we talk about the setup being centered around the stock price. If you read the strategy and you scroll down a little bit, we just talk about the stock being right around strike B. You don't want a lot of movement. You want time decay to happen. You're selling 2 puts at that strike, and you hope that it stays within the range, within strike A and strike C. Time decay or decreases in implied volatility could help you if you're correct on your forecast. Okay, now when I'm using a long put or a long call butterfly, if I'm bearish, I'm going to use puts and I'm going to go down below the market and target a price that I hope the market will go down to. And if I'm looking at calls, obviously I'm going to be targeting a price on the upside that I'm hoping that the market will rise to that price, to that center strike. So we're going to be doing it with puts because we're going to be bearish. Now, flip a coin. Are you bearish or bullish this week? If I look at the chart, I'm going to lean a little bit bearish. We've had a big run up in the markets. Is that over? Let me run and look at the chart here. Let me pull up the chart. 1 second. No, not quite. There we are. Okay, there we are. Okay, so if I have the chart, we had, they call this a golden cross. I don't put a lot of weight into it as far as the chart is concerned, but it did work out this time. I think it matters more when you're dealing with a 200-day moving average than when you're dealing with the 50 and 20-day moving average. But we did have the 20-day cross over the 50-day, and we had a strong bull move. So this is a daily chart going back approximately a year. And you see, I shouldn't say approximately, going back a year in time. But with this, we had that strong move, and we plateaued right here. And I find this to be an interesting place. If you look back and you look at my little ray that I've drawn, up here we butted up against that and fell precipitously. Right here was a pretty big downturn. This back in March, this was providing support for the marketplace. So I just find this to be an interesting area. We ran all the way up to the 200-day moving average, and I mean almost hit it to the penny. And now we're back, and now we've broken below the 20-day moving average, and we're right at this little range. So this is part of the reason. I haven't looked at a chart in a while. This is the first time, and I guess a few stock plays of the day where we're really looking at a chart to try to decide what strategy that we would like to do this week. Once again, not meant to be a recommendation. This is a purely speculative play that we broke below the 20-day moving average. We broke below this 4162 level in the S&P 500 index. So we're going to do something fairly inexpensive to try to speculate that the market by the end of the week might be down. That simple, that straightforward. So let's go back to the Ally Invest option chains. And inside the chains, we have the puts on the right side. We have the calls on the left side. The strategy that I already have set up is going to be a 3-legged trade. It's going to be the butterfly. Buy 1, sell 2, buy 1, and trade all as one trade for a net debit to the account. The VIX is up. When the VIX is up, butterflies become cheap. If you're correct on your forecast, you want the VIX to go down, ideally, or you want time decay to happen. And what's really nice in the S&P 500 index is you have a plethora of different strikes. So now they have, if I go and even look at, there's more expirations in the S&P 500 index than any other index out there. You have an August 24th, 1 day, you have the 25th, 2 days. This is the Friday expiration. It is a weekly. It will stop trading at the end of the day on Friday. They even have some of them that are European expirations. So the chain is very confusing. You want to make sure that the terms and conditions of the options in the S&P 500 index, anytime that you're going to trade it, just make sure that you know what expiration you're using and what terms and conditions go along with it. It's the only chain disseminated by the Chicago Board Option Exchange. Well, I shouldn't say the only one. They might have a few others, but the only one that mixes European style options with American style. And if you don't want to go into too much detail on that, we don't really have enough time to address it. Okay. So if you need to do it, do a little research and you'll be able to figure out what I'm talking about. Okay. So the market right now is at 41.26. Okay, so the market has dropped a little bit. So this trade has gone up just a tad. I think I'm going to adjust it. So since we've been talking, the marketplace has moved. So I'm going to clear out these options and I'm going to go down a little bit more. So I want to get this done I only want to spend less than $200 to speculate on a 1x2x1 butterfly on a downturn. And if we do this, let's go and type SPX in again, refresh our quote. And now we're going to look at scrolling down. We're still going to go 20 points wide, but the market has dropped too much for me to, what did I do here, Brian? Here we go. I don't need that many strikes. Okay. Okay, so we're going to use the 125 strike option on this put. I want to make sure I got the right expiration. 3 days away, September 26th. And we're going to go 20 points wide. So how will I set this up? Inside the Ally Invest option chains, it's really easy to do advanced strategies because we have these nice little check boxes here over on the right-hand side to select your option. So I'm going to be buying the 125 just out of the money. I'm going to go down 20 points and I'm going to sell the 41.05. We're going to be selling 2 of those. And then we're going to go down to the 85 equidistant and we're going to be buying one of those. Now, this is always fun about the stock play of the day. We're using real markets. So the market moved too much since the beginning of the show to the downside. Would have helped out our trade if we had to start with. But so now if I look at this trade, we're going to be doing it midpoint. Let's call it 150. It's going to be jumping all the way around. I like the 150 mark. So 150 is where we're trading at. 125, 85. Okay, make sure I got everything equidistant. And we'll look at the profit and loss. Actually, let's pull up the profit and loss graph. So here's the situation in the S&P 500 index. It has a little bit to do with what we just talked about in the USO. If I do this trade, here's where the market is at. And as of today, the green line is showing my profit and loss. Now, it's basically a flat line. So on the way down, if we don't get any time decay, it's hard to get profitable on this trade. We can do this for a net, and this is part of the reason why we can put the trade on 40 points wide, right? There's a 40-point range, well, not quite 40. Your break-evens are, you got to take out the $1.50 on it, but about a 40-point range where this trade will be profitable if the market does go down. And we're only paying $150 plus commissions for every 1x2x1 butterfly. And you see that the risk is defined. On the way up, it's defined, and on the way down, it's defined. There is an adjustment to the trade if you wake up tomorrow and the market is up, but you only have a few days to make that adjustment. I would want to make the adjustment on Wednesday, maybe on Thursday, depending on where the volatility premiums are at. But our ideal thing is that the market would continue down. It's already down a little bit since the top of the show, and we want it to land somewhere around the 105 range. Now, the maximum profit that you can make on this is 20 points. This could basically sell for $2,000. Now, if you did that and you actually received the $2,000, I'd also say that you should receive the stupid award for that, because if you actually hung around thinking that on Friday the S&P 500 index was going to stop right at our middle strike, 4105, well, you just got lucky, right? And the probability of that happening is extremely low, and you should have closed out the trade before and not tried to make the home run on it. So have realistic expectations. You're putting this trade on for $1.50. If you can close it out for $3, $4, you're fine. That's the type of profit that you should be looking to make. If you doubled on your trade, put it on for $1.50, sold it for $3, be happy, move on. It's a short-term speculative trade. Don't be looking to try to make that home run on the trade. Now, my ideal situation would be that tomorrow would be down a little bit, and then it would start creeping this way as Friday approached, getting some time decay. Volatility on the way down usually increases, so that's not necessarily going to help you. But by Friday on the close, these options, all the time decay has to go away, all the time value has to go away, just by the definition of option trading, right? We're going to approach expiration. When there's no time, there's no time. All right, so that's the trade that we'd be looking at. Now I'm going to go back up, since this was a more advanced trade. I'm going to now add it to the right rail, which means this is our official paper trade for this week. And what we're looking to do is buy to open one of the August 26th expiration 4125 puts, sell to open two of the 4105 puts, and buy to open one of the 4085 puts. We're going to work it at the midpoint. This is a very, very liquid index. The markets are a little bit wider than you would see in a normal stock that had this price on it. That a normal stock option may be, and that's mainly because the cost of the index, the valuation of the index is so big. But the markets, they're very liquid. I would feel fairly comfortable trying to fill this close to that midpoint of 150. So I'm going to put 150 in here. Never a guarantee on that. And don't forget about commissions. 1 by 2 by 1, there's going to be a lot of commissions because you're trading 4 option contracts overall. But we're sending this to the floor all as one trade, saying that the prices need to line up and they need to match the 150 level in order for us to be executed on this trade and have that position go into our account. All right, so that's the paper trade. I'm going to close the right rail, and I'm going to open up the question in the chat box. And if you have any questions, put them in. We can talk about the USO trade if you'd like, or you can also chat about what we're looking at here in the S&P 500 index. I realize the last 2 weeks have been kind of advanced. I've been sticking with leading into this. We looked at a lot of just bottom fishing trades, which are fairly straightforward. But I also have to admit that whenever you're dealing with puts and you have puts inside the option strategies that we're talking about, puts are definitely way more confusing than calls. And it's quite simply that when you buy a put, you're looking to sell the stock. You exercise that put, you're selling the stock at the strike price. So buy means sell as opposed to call, where buy means buy. That's straightforward. Okay, looks like we got some questions in here. So let's see where we're at. Well, thank you, Wayne, for the comment. I hope the vocals cleared up. Okay, so we got a thumbs up from our producer. I'm trying to finance a good price on a butterfly now. All right, Sony. But once again, this, you need to, if you're looking at these trades and you've never done them before and you've never done a butterfly, I'd much prefer that you just watch it. Put it on paper, put down the price, watch what happens over the next couple of days. Don't ever just jump into it. One of the biggest things about this SPX butterfly is that the price doesn't move that much. So if the market did go up tomorrow, you wouldn't be down a ton on it. You'd probably still be able to sell it and get out. Let's say if we went up the 20 points as opposed to down the 20 points. And what I've done before, if the market did go up, I have actually rolled it into a short put spread, hoping that the market stayed up. And a lot of times you can do that in the S&P 500 index and offset the net debit that you paid for it. Now, you add a lot of risk by doing that trade, but that's one of the adjustments that I like to make from a butterfly into a short put spread. All right. IV crush, like a calendar spread. Yes. Also, Sonny, this is, sometimes butterflies, calendar spreads, Sonny references, are a lot of times referred to as the poor man's butterfly. So if I look at a long calendar spread with puts, notice the profit and loss graph looks very similar. Much harder to understand and much harder to manage. I don't do calendar spreads in the S&P 500 index. It just has a lot to do with the cash settled feature of an index. But I like calendar spreads on stocks, that a lot of them that are going to be announcing earnings. That's where my favorite trade is. And I haven't done a long calendar spread, so maybe I'll look for one. We're at the tail end of the earnings season, but I like to do something where you're going to get that volatility crunch after earnings. Yeah, that's simple. And actually, the volatility rise or increase going into earnings is one of the things I like to try to work into my calendar spreads. Okay. All right. Thank you for the more advanced trades. Well, all right, Clinton, I'm glad that somebody likes them. I wanted, okay, looks like it's Charles Wood. Okay, so just talking a little bit about the trade. So now I see one from Charles. Would it be similar to using the ETF SPY at a lower cost? Yes, you could look at the SPY. That's a feasible trade. That's a 10-to-1 situation. So we're looking at doing this trade in the S&P 500 index. It's feasible to do. Now, if you did it in the SPY, there's a couple of things. You have a much lower valuation. So one of the things about a 20-point wide spread, there's an interesting dynamic that happens, right? If it's 20 points in the money, it's intrinsically worth 20 points. And if you're correct on your forecast, I think it's easier to get paid on a more expensive index as opposed to going 2 points wide in the S&P, in the SPY. There's just a different pricing dynamic that happens, but you could do an entire course on that dynamic. So I would prefer to stay in the S&P. And other things is that it is cash settled. There are some tax implications if you are trading in a non-IRA account, that there's some benefits in the S&P 500 index, but I can't talk about taxes on this show. You need to consult somebody about that. So I prefer to stay in the SPX. One of the biggest benefits about the SPY, though, is there's more transparency in the marketplace as to where you might be able to get in and get out. They're tighter bid-ask spreads. But remember, a 1-cent spread in the options in the SPY is a 10-cent spread in the SPX, just because it's multiplied by 10, right? That's the difference between the S&P 500 index, the actual index, and the SPY. Now, if that was confusing to you, just let me know. I'll come back and I'll try to explain. But you can use it, and maybe if you want, if you're looking at a test trade or something like that, it'll be a very inexpensive one lot to do a 1x2x1 in the SPY. But I prefer that everybody does this on paper, mainly because all we're doing is taking market conditions, looking at what's going on in the marketplace. The reason why I considered this trade is we did have a down day. We had the big run up. The chart looked a little interesting, but the VIX ran up. The VIX ran up to the 23 level. When the VIX increases, in particular, the VIX is attached to the S&P 500 index. That's how they calculate it. So when implied volatility, I should probably say it this way, when implied volatility in the S&P 500 index goes up, the butterflies, you're going to be able to execute this trade at a cheaper price. And I can even get more. I've looked at this butterfly in particular enough to know that if the VIX was trading or the implied volatility came down to about the 12 level, this trade, when you initially put it on, same distance out of the money would be about $3 as opposed to $1.50. It almost double the cost if the VIX was down around the 12 or 13 level. That's been my note. That's how much I've looked at this trade over my 20 years of option trading. All right. All right. That's simple. And one of the things, Charles, too, is just that's one the thing that's so interesting about this trade in general is that by Friday, there's so much time premium in the S&P 500 index that by Friday, all of it's got to be gone. That simple. We've talked about Amazon before. They always announce earnings on a Thursday before the Friday expiration of the weekly option contracts. And because of that, it makes it interesting to do butterflies in Amazon because they have one day to live. And if you're correct on your forecast, you need time values to go away. It was much more interesting when Amazon was a couple $1,000s prior to their split, but it still applies. It still applies. But I don't know why Amazon always chooses Thursday. A lot of the other companies just change it up. But for years and years and years, I have noticed that Amazon always announces on a Thursday after the close. All right. Sony, thanks for the statement. Butterflies are great when you get a hang of them. Yeah, they can be. Oh, I look like I'm running a little long. Thanks for all the questions, everybody. Really appreciate it. Please share with all your friends and let them know that Stock Play of the Day is here for all. We'd like to just join the increase the viewership. So please click subscribe, ring the bell, hit a thumbs up. Let us know what you like about the show in the chat box. We want to make this an open forum for all. Thanks for coming, everyone. See you 1 week from today.